All right, today we're going to put on our detective hats. We're going to break down a technical analysis report, piece by piece, like it's a crime scene. Our subject? Stock MO. Let's see what the clues tell us.
So every investigation really starts with one central question. And for MO, it's this. Is this stock a bargain that's just waiting to be snapped up, or is it a trap that's about to spring? The data should hold the answers, so let's start digging.
You know, in any investigation, you start with the most obvious evidence, the stuff that's right there on the surface. For us, that's the stock's price and the general direction it's been heading. This gives us the basic lay of the land.
Okay, clue number 1. The current price, $57.99. This is our starting point. It's the central fact that everything else is going to revolve around.
But a price by itself doesn't tell the whole story, right? You need context, and here it is. That current price is trading below its 200-day average. Now, for analysts, that's a pretty significant red flag. It tells us the stock's recent performance is weaker than its longer-term story.
And when a stock is consistently trading below its long-term average like this, analysts have a name for it, a bear market trend. This isn't just a feeling, it's a technical label based on the hard data we just saw. It means pessimism is kind of in the driver's seat.
And if we zoom out a bit to look at the whole year, we can see the stock is hanging out in the lower half of its price range. It's much closer to its annual low than its high, which, you guessed it, just adds more weight to that bearish evidence. So far, the story's definitely one of weakness.
So price tells us what's happening, but volume can help tell us why. By looking at volume, we can try to follow the money. Is it flowing into the stock, or is it heading for the exits?
To do this, analysts use a tool with a really fancy name, the Accumulation Distribution Oscillator, or ADSC for short. But don't let the name throw you. Just think of it like a money flow detector. It sifts through all the price and volume data and gives us a simple verdict. Are more people buying or selling?
And the reading from our detector is negative 3.3 million. Yeah, you don't need to be a Wall Street pro to see that is a big negative number. In our investigation, a clue this significant, it can't be ignored.
So what does that clue actually tell us? Well, it translates to this. Distribution is active. In plain English, selling pressure is winning. The money flow, at least right now, is headed out the door. Okay, so we've looked at the obvious evidence. Now it's time to pull out the magnifying glass and look for the hidden signals. These are the technical indicators that can show us underlying momentum and pressures that you can't really see at first glance.
Think of this table as our forensics report. We've got readings from a few key indicators. The RSI, which measures momentum, is signaling bearish momentum. The MACD, which tracks the trend, is negative. The evidence seems to be overwhelmingly pointing in one direction, well, almost.
Because if you look really closely at that last indicator, the StochRSI, you'll see a potential twist in the case. It's the one piece of data that doesn't quite fit the pattern, and in any good investigation, you have to pay attention to the anomalies.
And that anomaly is the word oversold. The reading is at 0, which is an extreme. It suggests the selling has been so aggressive that the stock might be stretched, kind of like a rubber band pulled too far. And that means it could be due for a snapback, a short-term bounce. It's a little glimmer of hope for buyers in a sea of bearish data.
So now we have conflicting evidence. Most of the data points down, but one key indicator suggests a possible temporary reversal. This means the analyst has to consider two very different potential futures for this stock. It's a fork in the road.
On one side, you've got the bullish case, and it's hanging its hat entirely on that oversold signal, hoping for a bounce. But on the other side, you've got the bearish case, which basically says the dominant trend is in charge and the stock is likely to fall even further. So how do you decide between these two paths? Analysts watch these key price levels like a hawk. 57.79 is the support level. Think of it as a floor. 58.32 is the resistance or the ceiling. Which one of these levels breaks first tells us a lot about which scenario is likely playing out in real time. Okay, we've reviewed the price, the trend, the money flow, and all those hidden signals. We've weighed the conflicting evidence. Now, it's time to see how the analyst puts all these clues together to come up with a final conclusion.
And there it is. The final verdict is sell, avoid. So why? Because while that oversold signal was an interesting clue, it just wasn't enough to outweigh the mountain of evidence. The bear market trend, the negative money flow, and all the other bearish indicators that were all pointing down.
And that really leaves us with the core puzzle of any data analysis, doesn't it? When you find that one piece of data that contradicts everything else, do you treat it as a rare opportunity that the rest of the market is missing?
Or do you see it as a warning sign that you probably shouldn't bet against the dominant trend? That's the puzzle analysts try to solve every single day.